I have a simple 4-step set and forget strategy to invest your first $1,000. If you are interested, then this video is everything you need to know. Stay until the end because I will show you a demo how to buy your first stock. The first step is to know why you should invest and how even an average worker saving a modest sum of money can turn into millions. Let's say you save your money in the POSB bank. You put in $10,000 to start and then save $1,000 every month. The bank gives you, 0.05% a year? After 30 years, you will end up with around $370,000. That is not terrible, but it is not life-changing either. Now, let's compare to investing. So the same $10,000 upfront, you save $1,000 every month, but let's say it grows at 8% a year. That is the historical average of the global markets. After 30 years, you are looking at $1.6 million. Yes, $1.6 million. You put in about $360,000 of your own money, but the other $1.24 million is your returns. That is 2.4 times your money. That is the magic of compounding doing its thing. If you want to play with your own numbers using my Excel spreadsheet calculator, I have put the link in the description. It is free for everyone to use. Now you might say, sure, this much money surely comes with risk. Of course there are risks, especially in the short term. Prices can swing from global news headlines, interest rate changes, recession fears, or even shocking US headlines while you sleep. Things you cannot control. Market decline can last for months or even years, so please do not invest money that you need in the short term. But here is the good news. The longer you stay invested, the lower chance you will lose money. Look at the charts. It shows that over the long term, the market tends to trend upwards. Not perfect, but clear. This applies to the overall stock market. This is not individual stock because those can fall and never recovers. Now, let me tell you why you should invest. Honestly, the biggest risk is not the market going up or down. It is not investing at all. What if at age 67, you are diagnosed with a life-threatening medical conditions that wipe out half of your savings? Or what if you live longer than you expect and your retirement fund, including CPF, is not enough to keep up with the rising medical costs and everyday expenses? I can go on and on. Life is unpredictable and no one wants to be in that position. Now that you have understood why you should invest and the generous return you can make for you, you are now ready for step 2. Step 2 is about choosing an investment strategy that has consistently proven to work across decades of market history. Most people think that this involves learning a lot of strategies, techniques, and advanced skills. But I want to say this to you. You do not need to master any of that. For most people, all you need for your investment is a passive, low-cost, globally diversified index fund. This is the best set and forget strategy for most people. Think of an index fund like a big basket of stocks. Instead of picking individual companies, you buy little pieces of everything in that basket. The basket follows an index, which is basically a selection of companies meant to represent the market, like the S&P 500 index for the US market, or the global index like the MSCI World Index. You don't need to do any work. You are just owning a tiny piece of a lot of companies at once. Over time, this strategy tends to follow the market long-term growth, which historically goes up at about 7 to 10% a year. A popular index fund among Singaporeans is an ETF called the Vanguard FTSE All World UCITS ETF, in short VWRA. And I can understand why. It is truly global, covering many countries and exposure to 305,000 companies, big brands that you know and smaller ones that you will never heard of. You don't have to decide how much goes to US, Europe, Japan, and China. You don't have to decide which stock to buy. You don't have to pick which industry sectors to buy. You don't have to decide how much to buy for each company. The fund does everything for you automatically. In summary, investing in an index fund is the simplest strategy that has consistently proven to work for very long periods of time. If you would like to understand how the fund selects its holding, the fees that it charges, and how features like accumulating share class, pre-holding tax treatment, US estate tax benefit work, make sure to subscribe and I will break everything down in future videos. Now that you have chosen an index fund as your investment strategy, step 3 is the hardest part of your investing journey, knowing when to buy and sticking to the strategy. Here's the thing. Everyone is talking about AI bubbles these days. Some say that the market is overpriced. Some warn about the market crash is coming. And once you start investing, you will be bombarded by headlines about bubbles, downturns, and crises every single day of your life. And trust me, every time I launch my YouTube app, there's always one video that talks about market crash. I'm not downplaying the risk of a crash. And some of these headlines are seriously concerning and not funny at all. So when should you buy? This is where dollar cost averaging, or DCA, comes in. DCA is super simple. You invest the same amount of money on a regular schedule. Every month, every 3 months, or every year, it doesn't matter. As long as you invest, no matter what the market is doing. When the price goes up, your money buys less. When the price goes down, your money buys more. And over time, all those different prices averages out. Let me give you a quick example. Let's say you put in $100 into the same fund every month. In the first month, the price is $10. So you buy 10 units. The next month, the price dropped $5. So now your $100 can buy 20 units. In month 3, the prices rise to $8. So you get 12.5 units. After the whole 3 months is over, you have invested a total of $300 and now you own 42.5 units. Did you see what happened? When the market dips to $5, you are automatically buying more units without even thinking about it. Later, when the price recovers, all those extra cheap units starts working for you. Trust me, stick to this strategy because no one can time the exact bottom during a dip. More often than not, when you sit at the sideline waiting for the next dip, the market takes off without you. If you can, try to set up your bank so that it automatically transfers money to your broker one day after your salary arrives. And then set your broker to auto-buy your investment. And that's it. The whole system is running quietly in the background while you live your more meaningful, busy life. Step 4 is the most exciting part, buying your very first ETF. Step 4 is about choosing a broker and making the very first investment. I will show you a quick demo how to buy your first ETF, so stick to the video until the end. So which brokers should you use in Singapore? I have a checklist here, so let's have a look. It should be MAS regulated, low fee, and giving access to global ETF. And ideally, it should have auto investing features. Some popular options among Singaporeans are interactive brokers, super low fees, and global access. Moomoo, Tiger, Webu are beginners friendly and very easy to use. Banks broker like DBS Vickers, OCBC Securities, and UOB Kay Hian are very familiar, but their fees are higher. If you want to invest using your CPF OA and SRS, you can use Endowus. I have put links in the description for the platforms mentioned. Okay, let me show you a demo how I use interactive brokers to buy a global ETF. This is illustration only, not a recommendation. First, you log into your account. If you are on an iPhone, authenticate using Face ID. Just wait for it to load. Now on the main page, go to the left menu and click on deposit. Choose your deposit method. For me, I use Pay Now, which is set up earlier. Enter the amount, let's say $1,000, and click next. On the next screen, you will see a QR code. Now open your bank app. I'll use my POSB app. Scan the QR code, confirm the payment, and then go back to Interactive Broker and click finish. So in about an hour, your money will appear in your account. Okay, now the money is in. Now to search for the ETF, go to the search bar at the top and enter the ETF's ticker symbol. In this example, I'll use VWI, and then you select stock. So you have land on this page, and then on the right hand side, click buy, choose market order. Enter the number of shares. In this example, one share is about $167. So I will buy 4 shares, which is about USD $670. That is Singapore dollar 933. Now click buy order. Interactive Broker will automatically convert your Singapore dollar to USD dollar, so you don't have to do anything. So there you have it, your complete 4-step guide to investing your first $1,000. Your money is now officially working hard for you. From here on, just keep dollar cost averaging every time your salary comes in and stick to the plan. It is really that simple. I have also put some popular brokers links in the description so that you can start making an account after this video. If you have any questions, drop a comment below. My next video, I will dive into how an index fund works and why beginners like yourself should consider investing in an index fund and the best ETFs for beginners in Singapore. So make sure you subscribe because you will not want to miss it. I will see you next time. Thank you.